22nd annual meeting for the investment community. It's great to see a lot of familiar faces that I've seen before when I worked in IR back in the 2004-2007 timeframe, and so it's great to see you again today. I lead the Global Investor Relations team, and I'm very excited for this meeting today. You all are familiar with our forward-looking statement that we must show you for the meeting today. Also, I wanted to share with you that all of our information is going to be available on our corporate website at stock.walmart.com. And as always, at the conclusion of the meeting, the investor relations team will be in the offices this week to answer any of the calls that you have. With that now, I'd like to welcome to the stage our President and CEO, Doug McMillon.
Good morning. Thanks for being here. Hopefully this is handy for a number of you, and we'll get your feedback after the meeting to let us know whether you like doing it here or Arkansas, or you want us to bounce back and forth. But we're excited to be here and to do things a little bit differently this time. Before we get started, I want to recognize a couple of people. You heard last week that Charles Hawley has made the decision at the end of our fiscal year to retire, and Charles has been with Walmart for more than 20 years. He's had all kinds of jobs, helped build the international business, has been the controller. He's just literally done it all, and since 2010 has been doing this job. And he was willing to hang around a little bit to help with my transition, so he actually stayed longer than he originally intended, and I really appreciate that. He's been a great partner. Would you please join me in congratulating Charles on his retirement? He'll be up in a few minutes, and if he makes any forward-looking statements that I don't agree with because he's not going to be here, I'll jump up and tell you what those were. We're also excited to announce that we've got an able replacement to step up in Charles's place, and Brett Biggs has been with the company for just a little over 15 years. Like Charles, Brett has had a lot of different jobs. He's worked in M&A, he's worked in Treasury, he's been in Walmart International as a CFO most recently. Before that, he was a CFO in Walmart U.S. And even for a little bit of time, we asked Brett to go learn how to be an operator. And he took on a responsibility in Sam's Club to run a big group of our stores and did a great job doing that, further developing his leadership skills. Would you stand up, Brett, and let us recognize you and congratulate you on your promotion. We've been listening to you and have tried to set today up to answer a lot of your questions. What we're hearing from you is we want further detail, more refined detail around your strategy. What is the plan to win? Is it credible? And can you do it all? We've also heard you clearly say we need to know more about the numbers. Tell us about the financials and help us see out a ways. So today we're going to do things a little bit differently. I'm going to kick off the discussion by talking to you about our overall strategy as a company. And then Charles is going to come up and talk about our financials and talk about more than just next year. Given that the transformation that we're leading in the company is going to take more than 1 year, we think it's appropriate at this point in time to give you a further look out. So he'll be talking about forecasts related to growth, profitability, and capital for the next 3 years. And he'll comment on our share repurchase program for the next 2 years when he comes up and takes the stage. Following Charles, we'll have a focus on Walmart U.S. and e-commerce. So Neil Ash and Greg Foran will come up and talk about those businesses. We decided to focus just on those two big segments because that's where most of the investment pressure that we're putting on the company's earnings are appropriately tagged. So big investments in Walmart U.S., big investments in e-commerce. We wanted to go deeper there, answer all your questions about those businesses. Clearly, Sam's Club and Walmart International are really important to us, and they will be reflected in the total company financials that we cover with you today. But our thought is we'll come back at another time and have a focus on Sam's, have a focus on International, and let you ask us questions about them at that time. After the two of them speak, I'll come back up and say a few things, and then eventually, before too long, we'll come up and answer all your questions so that you can fill in any blanks that we have not addressed. Let me kick off today's discussion by talking about the overall strategy as a company, and I'll remind you that I'm going to speak from a global view, not just the United States. Here's the key point. Walmart is uniquely positioned to win the future of retail. We have a combination of strengths and assets to build on, and we're preparing the company for the future. Our investments in people, our stores, and our digital and e-commerce capabilities are the right ones. Let me set some context. We all know that retail has changed and will continue to change at an accelerating pace. We also know that what we did in the past wouldn't by itself be enough to win with customers. Competition is strengthening. Pure e-commerce businesses move fast, innovate well, and run on lower margins. Hard discounters run on lower levels of profitability, and they're growing quickly. We know there's a lot more change to come, and we're motivated by it. Competition is good for the customer because it makes us all better, but it's also fun to take advantage of the opportunities that are presented. Retail history is very clear. Those that are unwilling or unable to change go away. Those that get ahead of the curve will thrive. That's why we're taking decisive steps now to change and grow our business. We can deliver stronger financial performance in the short term simply by running our core business better, but that won't be enough. To win, we must run the business well today and change the business for the future. We will lead and not just manage. We have work to do, but we're coming from a position of strength. We have assets any retailer would want. Globally, nearly 260 million customers shop with us each week in stores, clubs, and online. We have a well-developed supply chain that we're strengthening for e-commerce. We have a reputation for value and are trusted around the world. We have a strong culture and more than 2 million dedicated, hardworking associates. And we have strong cash flow. And we're changing. When we stood before you a year ago, our sense was that we hadn't been changing quickly enough or boldly enough. So we've been investing to get stronger and faster. Specifically, we're investing in people and technology to evolve our customer experience to serve them today and tomorrow. Now, we made a significant commitment to our store associates this year and next. We took a leadership role to increase wages and to get the talent we need. It was the right thing to do. We also changed our U.S. store structure to create more ownership among our associates, and we're making changes to our training and scheduling programs. In our U.S. supercenters, we had leaned too far towards expense leverage. Greg took on a big job about a year ago, and we're making solid progress. I've been out in the stores these past few months, and I try to always ask our store associates and our store manager at the end of one of my visits, what is it that we can do for them? What do you need from us? And I've been hearing a really consistent message lately all over the country. One of them recently came from a store visit to Ames, Iowa. We have a supercenter there with a manager named John, and John didn't know I was coming, and we got into the store. It took him kind of a couple of minutes to get his bearings, but as we turned and started walking down the action alley in front of ladies' wear, we saw a department manager walking out on the floor, and he stopped me unsolicited and said, you know, what we're trying to do is working. Our additional department managers, what we've done with wages, with structure, and the other changes is resulting in the ownership that you're trying to create. And I was so encouraged by that because that's ultimately what we're trying to do with our store associates. For those of you that have been following us for a long time, you know that when our department managers take ownership and run a store within a store, that part of the store looks better and runs better, drives more sales, has happier customers. That ownership is what we're after. So the steps we're taking are making a difference. And when I hear store managers around the country say to me, you've done it all, it's on us, we've got your back, I'm really encouraged by that. And I'm hearing that consistently. Our people really do make the difference. Now, we've also been building an e-commerce business. We've been hiring top technology talent in Silicon Valley and around the world, refreshing the customer experience and becoming a true internet technology company. We're now one of the top 3 online retailers by traffic, and our Walmart U.S. app is among the top 3 apps in retail, with tens of millions of customers downloading it and using it regularly. These investments are critical to our future, and they are core to our strategy. We are excited about the opportunity before us and our plan to win. We have a growth strategy that leverages our strengths. Here's what we'll do. First, win with stores. We know customers love shopping in stores, and they'll want great stores tomorrow. And why wouldn't they? The chance to interact with products, to see something new, to look at an item, touch a fabric, smell something, see a color. It's important to them. The opportunity to buy something and take it home right away is satisfying. Now, stores will be different, and those we operate today need to change, so we'll keep refreshing them to make them relevant for the future. They'll be more convenient, for example, whether it's a stock-up trip or a top-up trip. The in-store experience will be critical. which is why our investment in people this year is also a bridge to our future. These things are not unrelated. Second, we'll add capabilities to our supply chain. It's been one of our most important strengths, and we're working to morph our supply chain of today to enable us to win in the future. Today, most of our distribution centers were obviously built for the purpose of serving stores. We're changing that to have a stronger each capability for moving individual items. We will connect our various types of DCs and stores and improve our inventory accuracy and efficiency. Optimizing the inventory in our system is a huge lever to serve customers better and to take a lot of costs out, not only through transportation and handling, but also through markdown elimination. A dynamic, connected supply chain with improved forecasting, leveraging predictive analytics, can serve customers and reduce costs by merging truckload, pallet, case, and each movement. Accurate inventory placement is a really good way to make money. Later this month, we'll mark the 10th anniversary of Lee Scott's Leadership in the 21st Century speech, which set us on a path towards becoming a more sustainable company. Our holistic supply chain is a huge part of that. Moving forward, our supply chain will be an even more effective asset if it is resilient and more sustainable. We are actively engaged in reshaping the systems in which we work. We can not only strengthen our business, but use our scale and our capabilities to make a real difference in the world. We look forward to updating everyone in more detail on our sustainability journey and vision in the coming months. Now, in addition to winning in stores and with our supply chain, we will build deeper digital relationships with our customers. As we grow stronger at technology and innovation, we will become competitive against the best digital players. We have the team and the resources to do it. But that's not where we win. We win on our unique combination of assets. Our opportunity to build digital relationships with customers in ways that are seamlessly integrated into their lives is an important one. And we're building that relationship today through our improved site experience and apps. Tomorrow, we'll build it through an enhanced store experience, including how they find items, how they pay, and how they check out. When you add it all up, here's our plan. We'll be the first to deliver a seamless shopping experience at scale. No matter how you choose to shop at Walmart, in stores, online, mobile, or a combination of them, it'll be fast and easy. We're uniquely able to save customers time and money in any channel and blend them together. We'll give customers what they want in a way that works with their lives. At some point, they won't even think about how they ordered it or how they shopped. And the lines between shopping in a store, picking up an order at the store, or having it delivered will just fade into the background. Today, we're seeing e-commerce companies test stores. It's because they see the same customer desire that we see. Here's a key question. Will it be easier for an e-commerce company to build out a massive store network and create a customer service culture at scale? Or are we better able to add digital and supply chain capabilities and leverage our existing stores? We like our chances. As we do that, we'll grow what we call the sweet spot of our customer base. Our best customer shops with us not only in stores, but also online. They spend more, shop more frequently, and give us a higher share of their wallet. If you look at these circles, you see our average store-only customer in Walmart U.S. spends nearly $1,400 a year with us. The average online customer spends a little over $200 a year. But the customer who shops us through multiple channels spends more than $2,500. These are the customers everyone is chasing, and we already have a relationship with so many of them. This overlap will continue to grow. Eventually, it will be our biggest revenue segment represented on this slide. It's a big opportunity. As we build and deliver this seamless experience, we are positioning for growth in areas customers want most. We see clear trends around the world that offer huge opportunities. I want to take a minute and walk through where we're leaning in. Let's start with price leadership. We're rightfully known for value. Our purpose of saving people money so they can live better is real, and it matters. We made a choice, though, to first invest in technology and people, and those investments are putting pressure on short-term earnings. The large investments this year and next in store experience, operational improvements, and wages will ensure we get the sales lift we deserve for lowering prices further in the future. To put it more simply, you clean up your house before you invite people over. It was smart to improve standards, in-stock, and checkout speed before just leaning on price. Greg will also say more about the work we're doing with private brands to offer savings to customers. We represent value, and private brands will be a key part of our future. The second growth area is convenience. Wasted time is a cost to the customer, and we can help them save here too. E-commerce is inherently convenient. By broadening our marketplace assortment, creating better websites and apps, and using data and personalization, we're offering customers better choices every day. And we see a huge opportunity through pickup, particularly in grocery. The combination of a digital relationship and stores is a winner. The customer response to ordering groceries through online and mobile and then picking up in the parking lot has been tremendous. Here's one example. I want you to meet Carla. A few weeks ago, I was on a store visit. I was in Huntsville, Alabama. As soon as we got to the store, I saw a pickup area that we had recently added to the front of the store, and I saw a customer up there picking up the order. It was early in the morning. So I walked up to Carla, and just after a few seconds of her talking, I asked her if I could take out my phone and record the conversation. She said, no problem. What you're about to see is spontaneous and unscripted from a few weeks ago. Meet Carla. So tell us your name.
My name is Carla Johnson.
And Carla, is this your first time using the pickup here at Walmart?
It is, very first time.
And how's it going?
It's great. Y'all do it.
Saving you some time?
Check it out. It's saving me a lot of time because I have a 1-year-old and I just got all my groceries for the month and they brought it out to me, and that's less hassle for me because it takes a lot to get him out, out of here and then going into Walmart. And again, I forget something every time. So I took my time and ordered, and I have everything I need. So I didn't forget a thing.
Do you normally shop here?
Yes, always. So.
Well, thank you for your business. Any advice for us?
Any advice for y'all?
Yep, how to get better?
Keep it.
Thank you very much. Nice to meet you.
Thank you.
Sometimes I dream about 260 million customers being that happy all the time. And what kind of a comp increase would we really be running? I mean, that was just a lot of fun. And it truly is representative of the behavior and the attitude we're seeing from customers as we expand on this test that we've been doing and start to scale it. Online grocery has the potential to bring in meaningful amounts of new customers. In the last 6 months in Denver, 1 in 4 of these customers is new to Walmart. 1 in 4 new to Walmart using grocery pickup. Another cool dimension of this is that we can combine online grocery shopping with the full breadth of our assortment. One customer I recently met was over the moon about the opportunity to pick up her back-to-school list with her groceries all in one stop. Order on the app, pick it up all together. She's absolutely pumped. It's a key differentiator for us that customers can eventually pick up a snow shovel in the winter with their milk and eggs without getting out of the car. Neil will share more about our plans to continue rolling out this service, and we're all really excited about it. Neighborhood markets also offer convenience. They offer the easy access of a local grocery store with the endless aisle of Walmart. We've continued to refine the format, and Greg will talk about the new neighborhood market that we opened just last month in Rogers. It happens to be across the street from the very first Walmart store that Sam Walton ever opened, which is cool to walk out that store, look across the street, and see that location. I posted a photo from that store's fresh food department on Instagram because that's the area we are most focused on improving, fresh food. Positioning for growth also means being great merchants. We're aggressively pursuing the opportunity around fresh foods and health and wellness. The projections are for $2 trillion in global growth over the next 5 years in these categories. At Sam's Club, we doubled our organic offerings last year. At Walmart U.S., we're growing at double the rate of the industry in organic produce. But we still see more upside in our presentation and our assortment, and we're on it. We'll also continue to win in general merchandise and apparel. And our recent sales performance in those businesses has been lifting the box, raising the average. Our core merchandising strength gives us an advantage, and we've got to keep that going. Our fourth driver of growth is to be strong in priority markets. We will win in the geographies where customer spending is growing the most. We have a sharp focus on North America, and particularly in the United States. Our U.S. performance drives the company today, and it's a strong source of growth for the future. The Supercenter is the greatest format in retail history, and it will continue to be a huge driver of our growth and profits. Yet we have the opportunity to reimagine the Supercenter, to refresh it, to ensure that the format remains strong long into the future. The other market we're prioritizing is China, which will be home to 25% of total retail growth over the next 5 years. As the middle class continues to grow, we see an incredible opportunity, and we've been putting the pieces in place. We've now built a supply chain that supports the parts of the country where we're focusing. We've improved how we run our more than 400 stores and clubs. And this summer, we acquired the remaining shares of our e-commerce business, eHowdian. We have a unique opportunity and a plan to put it all together to win in China. The final growth area I want to highlight is appealing to a blend of income levels. Globally, we know growth will disproportionately come from middle and upper income households in the years ahead. In markets where we have a presence, middle income households are projected to drive 50% of total retail growth. Today, we appeal to value-oriented customers in all brackets. This slide shows a distribution of household income in America and shows how our shopper matches against it. Please take a close look at it, because frequently perception does not match reality. By taking the steps I just outlined, we're going to increase our share across this whole curve. Areas like fresh food, grocery pickup, and neighborhood markets appeal to a broad range of customers, and we want them all to shop with us. By now you may be thinking, can we do it all? Can we transform the company in this way in every market and business fast enough? Do we have the talent and the capital we need to deliver this seamless shopping experience everywhere we operate? No doubt our business has become both large and broad. It's more important now than ever that we evaluate our portfolio. We've exited businesses before. We were the largest full-service restaurant operator in Mexico, but we sold that business last year. We used to be in banking in Mexico. We aren't anymore. We operate a property company in Chile that's now on the market. We've closed stores across several markets, and we will continue reviewing our fleet in a disciplined way, and we'll close the stores that should be closed. We won't let the breadth of our business distract us from our most important priorities. But we don't believe in shedding assets in a hurry for less than they're worth. Value and timing matter. We're more than open to reshaping our portfolio, but we'll be smart about it. Now, today you're going to hear a lot of information through all of our presentations, and as you listen, I'd ask you to focus on these key takeaways. We know where and how we're going to win. We'll be the first to deliver a seamless shopping experience at scale, and we come at this work with unique strengths. Second, we can grow sales at a rate that's faster than the market. Third, we will be disciplined with our capital. And finally, we'll come out of this investment period with strong returns for shareholders. Charles will say more in a moment, but I want to address this as well. Our investments in people and technology will continue to pressure our profitability in the near term, especially next year. We will then be positioned to be competitive with an attractive level of profitability. And we understand that the dip requires patience from our investors, and we want to be very clear. These are the right investments for our future. We see an exciting opportunity to drive sales today, invent tomorrow, and ensure sustainable growth. Over the next 3 years, our dollars of sales growth will be like adding last year's combined annual revenues of Netflix, eBay, Whole Foods, and Starbucks to our top line. Netflix, eBay, Whole Foods, and Starbucks, last year annual revenues, we'll add that in the next 3. This is a growth company. It just happens to be a really large growth company. I'll come back up in a little while for Q&A and wrap things up, but now I want to hand things over to Charles Holley. Please welcome Charles.
Thanks, Doug. Good morning, and thank you for being with us today and your interest in Walmart. This will be the last time that I address our annual investor meeting, so it's kind of bittersweet. But I really feel fortunate to work for such a great company with a lot of great people. And I've also really enjoyed working with all of you over the last 10 years. I'm excited for my successor, Brett Biggs. If you've been around me any length of time, you know that you've heard me talk about how important our talent development and succession planning is at Walmart. Brett is a great example of that. He's extremely talented, and he's definitely ready to take the CFO role. Many of you know Brett already, but if you don't, make sure that you meet him today. Now, before I dive into the details of the future guidance, I'd like to give you an update, a financial update on what the guidance scorecard from fiscal year 16 would have looked like that we set out for you last October. You know, we've experienced increasing sales momentum in our Walmart U.S. business, and we continue to see improvement in our customer traffic. However, the impact of currency on our total global growth has been much stronger than we anticipated a year ago. We now believe that our total net sales growth will be relatively flat for fiscal year 2016. It's important to note that if we exclude the impact of currency, our total net sales growth would be around 3%. And that would include Walmart U.S. growth of around 3.5%. Now, as we told you last year, we plan to invest in new technologies, specifically including e-commerce and digital capabilities. We've also announced earlier this year a significant investment in wage rates and store hours. Now, these investments have resulted in an increase in operating expense and a decrease in operating income. And operating income has been negatively impacted by a decline in gross margins in Walmart U.S., as we discussed in our second quarter earnings release. Now, in the first half of fiscal year 2016, we generated, though, around $5.1 billion of free cash flow. We know we still have more room for improvement, but that's a pretty strong cash flow. So now that we've updated fiscal 16 guidance, the scorecard, let's move on to the longer term plans. Now, as Doug mentioned, our strategic priorities that you're going to hear about today are about winning in our stores in the U.S. And we'll do this by continuing to focus on strengthening the supercenter format, optimizing our neighborhood markets. We'll focus on adding capabilities to our supply chain by building out the fulfillment network to create a seamless customer experience, as Doug just mentioned. Now, and finally, we're going to build a digital relationship with our customers through improved site experiences and apps, but also enhanced store experiences. Before we wrap up today, I'll also provide an update for our share repurchase plans. Now, in the past, we've given you one-year financial guidance as it relates to our strategies that we've laid out. Today, we'll give you more insight into what we see our performance will be over the next 3 years. And it's going to include sales growth, earnings per share, cash generation, and we'll also look at how we're going to use our cash, namely CapEx and shareholder returns. Our focus today, though, is Walmart U.S. and our e-commerce business. Now, there are some areas that we won't discuss today in detail, the first being our portfolio. You heard Doug talk about it. We're open to reshaping our portfolio, and we'll be reviewing all of our operations, including businesses and stores, but we'll be smart about it and ensure we drive shareholder value in all of our decisions. We'll provide updates on this topic as and when there's more information. The second item relates to international, including specifics on the opportunity in China. The third is Sam's Club. And we'll have Dave Cheesewright and Roz Brewer come back and meet with you at a later time to share more details about their plans. So let's start with sales growth. Now, Doug mentioned a number of points that I'll cover in more detail. We're in an investment phase right now, and we need to invest in order to change our trajectory. We're focused on winning with our customers and growth. And our geography does matter. Now, you may remember that I talked about our focus on the U.S. this time last year, as the shifting dynamics played and will continue to play a large part in determining how our plans are built for the future. You know, if we step back and look at the sales growth in 2012, you can see how International and Sam's Club combined were contributing over 3/4 of our total company sales growth. But in the subsequent years, Walmart U.S. has become an increasingly large part of that growth story. And as an example, within fiscal year 2016, Walmart U.S. has turned traffic and comp sales from negative to a positive. Our long-term plan projects the continuation of that positive momentum, reflecting around 100 basis points of further improvement in our annual sales growth and performance on a constant currency basis. Now, as a result, our annual sales growth for the next 3 years will add approximately $45 to $60 billion of new sales. $45 to $60 billion. Now, that's an annual growth rate of 3 to 4%. Kind of on the same lines what Doug just said, that incremental $45 to $60 billion, that's the equivalent of a Fortune 50 company. Now, as a reminder, all of our e-commerce sales are embedded within the business segments. But if we show the growth projections for e-commerce side by side with the segments, you'll see that we expect this business to be an increasingly significant growth engine over time, pretty consistent with what we've told you in the past. It's important to note that the operating losses will reduce over the next 3 years. You will hear more specific details from Neil and Greg today on how we'll drive this growth through our investments in this seamless customer experience. Now, in August, we provided an earnings per share guidance for fiscal 2016 of $4.40 to $4.70. Now, this range included updated assumptions for the impact from our wage investment of 24 cents, incremental investments in global e-commerce between 6 and 9 cents, and the impact of our headwinds from shrink and pharmacy of around 11 cents. Now, our range is wide, wider than probably usual because of discrete items, including the uncertainty as to whether Congress will pass the legislation on certain tax extenders. And whether this legislation is enacted will have a significant impact on that effective tax rate. And as you know, we provided guidance earlier this year that the tax rate would range between 32 and 34%. If the legislation is passed, we'll end up closer to a tax rate of 32%. However, if not passed, we could end up around 34%. Now, before I move off this slide, I want to take a moment to talk about how our sales mix is also impacting our profit. Within Walmart U.S., our business mix has shifted between formats driven by customers' desire for convenience and also by category as our mix continues to skew towards grocery and e-commerce. And this is important because of the effect on operating margin percentage. If you look at our underlying trend, you will see a reduction in the operating margin rate driven by our focus on meeting our customers' changing needs and the related format and category shifts. Before we look at the 3-year horizon for earnings per share, let me remind you that fiscal year 17 will be the second year of heavy investment for us, both in store wages and in e-commerce. This past February, we announced an increased investment in our associates through wages, training, and store structure. With this announcement, our hourly start rate moved to $9 per hour this year, and it'll move to $10 per hour next year. This program will result in increased cost of about $1.2 billion this year and an incremental $1.5 billion next year. Now, this is $2.7 billion of investment over a 2-year period. In fact, in fiscal year 2017, this wage investment represents approximately 75% of our earnings per share reduction. Now, additionally, we'll be making other operating investments within the stores, such as pricing and online grocery. You're going to hear more about that from Neil and Greg. With that information in mind, fiscal year 17 earnings per share will decrease by between 6 and 12%, driven by these heavy investments I just highlighted. But let's look a little farther out. By fiscal year 19, we believe our earnings per share will increase by around 5 to 10% against that previous year. Now, earnings per share it will be impacted by a combination of operating income and share repurchase, and I'm going to address share repurchase in just a minute. I've already covered reductions in operating margins driven by our wages and e-commerce investments, but I want to call out the other large investment, pricing. Over the next 3 years, we will invest several billion dollars into price. Our plan reflects some investment of price in fiscal year 2017, with the majority of the investment reflected in fiscal years 18 and 19 after we implement the wage investment. I want to clarify here, our plan reflects us resetting our financial base. These investments, along with the improvement of our e-commerce operating losses, will provide a sustainable foundation upon which we can provide profitable growth. We expect operating income percentage to bottom out during fiscal year 2017, and we anticipate margins climbing back to sustainable rates by fiscal year 2019, and they should remain relatively flat after that. Now, the results I just covered will continue to generate significant cash flow. Over the last 3 years, we've generated approximately $75 billion in cash. Over the next 3 years, we plan to generate around $80 billion in cash. Now, while we assume some progress in working capital in our plan, we're going to continue to look for opportunities which we think we have for further improvements. So let's talk now about how we plan to use that cash over the next 3 years. You may have heard me say before how we prioritize our cash. There's 3 ways. The first, growth. The second, dividends. The third, share repurchase. These priorities are supported by a very strong balance sheet and cash flow. Now, we're focused on capital allocation and ensuring it's aligned to our strategic priorities. For our capital to generate good returns, we know we must use it wisely, and we have to prioritize how we spend it. So let's start with the investment in CapEx. Now, our plans for the next 3 years reflect a reduction in capital expenditures. For fiscal year 2017, we plan to spend approximately $11 billion, and we expect to keep capital expenditures relatively flat through fiscal year 2019. For Walmart U.S., our capital expenditures will be down approximately $800 million, driven by the moderation of supercenter and neighborhood market growth, while we focus on assessing the format to ensure it meets our customers' needs for price, assortment, access, and experience. And you're going to hear more from Greg about that in just a minute. Now, international will show a decline of approximately $500 million as we evaluate our strategic priorities around the globe. Sam's Club will remain relatively flat as they continue to focus on strengthening their core business. And once again, as a reminder, global e-commerce is embedded within our segments. Our total e-commerce and digital capital expenditures will be approximately $1.1 billion in fiscal year 2017. That's related to our commitment to invest in technology and our fulfillment networks that we told you about a year ago. Now, it's important to note these numbers do not include acquisitions, and they're based on the landscape as we see it today. The numbers could change prior to or during a fiscal year, and as we react to strategic opportunities, we will come back and update you as we have more information. There could be projects that could provide incredible customer offerings and drive shareholder value, and we would make those investments. And additionally, if we identify an acquisition that would be accretive to the company, we would take advantage of that opportunity. Now, we believe during this investment period, it's critical to continue to deliver a return to our shareholders. So let's move on to shareholder returns, dividends, and share repurchases. As we've shown in the past, we remain committed to a good dividend to our shareholders. I can't tell you what the dividend's going to be going forward, but I want to remind everyone that we've had a dividend increase every year for the last 42 years. We are very proud of that record. I think it demonstrates our commitment to dividends and shareholder returns. Now, talking about share repurchase, as a reminder, over the last 3 fiscal years, we repurchased approximately $15 billion of our shares. Now, we've always remained committed to our strong balance sheet and said we would only use it for strategic purposes. And last year and this current year, we've not utilized that capacity as we've not felt it was the right time to drive a larger volume in share repurchase. However, we believe in the current landscape provides us a unique strategic opportunity to utilize the capacity of this strong balance sheet and cash flow. At the current time, we have approximately $8.6 billion remaining under our current $15 billion authorization. As part of our commitment to drive shareholder return, I'm pleased to announce that our board of directors has authorized a new $20 billion share repurchase program and the retirement of the remaining balance under the 2013 authorization. Now, our intent would be, with all else remaining the same, to utilize this authorization over 2 years. And that assumes no large acquisitions and no significant changes in planned operating cash flows. We believe this new authorization demonstrates the company's commitment to our plan. So, what does it mean when you put it all together? Well, if we take a look at the key metrics we're forecasting for fiscal year 2017, along with fiscal years 18 and 19, we anticipate adding $45 to $60 billion in sales for that period. Earnings per share will decline in fiscal year 2017, driven by our investments in wages and price. But by fiscal year 2019, earnings per share will grow to a level above where we are today. Let me say that again. I think it's very important. In fiscal year 2019, our earnings per share will grow to a level above where they are today. And by the way, our earnings per share for 2019 would be around where they are today, excluding the $20 billion share repurchase. Even with these investments, we plan to have strong cash flow, and we'll continue to use our cash to reinvest in the business. Now, capital expenditures will be approximately $11 billion next year, and they'll remain relatively flat for the next 2 years after that. We remain committed to delivering strong returns to our shareholders through our dividend and share repurchase programs. That concludes my presentation. And let me remind you, we're going to have one overall Q&A session. That's going to be after all 4 presentations. Right now, let's take a short break. We'll hand out the press release, then we'll come back and start up with Neil, who's going to walk you through our detailed plans for e-commerce. Thank you.
the stage our President and CEO of Global E-Commerce, Neil Ash.
Good morning. Today, I'm going to talk to you about the digital relationship that Doug said we're building with our customers. It's a digital relationship that's integrated into our customers' lives to provide them with convenience and with time. We've built out the capabilities to deliver a high-quality, pure e-commerce experience, including re-platforming our technology and our physical distribution. We're dramatically expanding our assortment, as well as the tools we need to win on price and at scale. Over the past 3 years, we've doubled the size of our business, and we've expanded in the U.S. and in places like China. We're now one of the 3 most visited online retailers in the U.S. We're excelling in pure e-commerce, but what Walmart can do that no one else can do is marry e-commerce with our existing assets to deliver a seamless shopping experience at scale. We're layering new digital capabilities over the store experience to make shopping faster and easier. Walmart has always given customers low prices. Now, we're also giving them the gift of time. So let me share 2 exciting examples. How we're using e-commerce to revolutionize grocery shopping, and how we're using mobile in the store. You know, Walmart transformed the grocery industry once before, and now we're doing it again. We're excited about online grocery shopping. With online grocery, customers are able to order their groceries on a computer, a tablet, or a smartphone, and then pick them up later that day without even leaving their cars. For a busy mom or dad, that's a game changer. Over the past 2 weeks, we announced that we're offering online grocery shopping with free pickup to customers in 8 new markets, ranging from big places like Atlanta to smaller ones like Ogden, Utah. That's in addition to the 5 where we're already operating. And tomorrow, we're bringing this service to customers in 10 new markets, including Dallas and Houston, Memphis, and in Tampa. Together, that will put us in 20 markets this year. And early next year, you're going to see another wave of 20 more, and we'll keep on going from there. Online grocery shopping is bringing new customers to Walmart, and it's deepening our relationship with the customers we already have. Doug showed you one customer in Huntsville. I'd like to show you another reaction we had from a customer that we met in Denver. Alicia came as we were visiting one of our stores there, and she literally jumped out of her SUV, and we pulled out the iPhone, and this is what happened.
So, what do you think about the service?
Okay, I am obsessed with this service. I love it. It is the best thing that has happened to me as a mom of 4. I cannot say enough about it. Every week, I look forward to doing this. It just saves my life. I mean, it just makes a huge difference in my life. And I have passed so many referral coupons on to all my friends. And I'm like, you all have to do it. It is obsessive. You will be addicted to it, and it'll be your favorite thing on the planet.
So you're a fan?
Kind of, sort of. I might be a fan.
And did you always shop in Walmart, or did you shop in other stores as well?
No, I shopped here, I shopped Target, I shopped Whole Foods, Vitamin Cottage, but I found that, like, just for that purpose alone, I do Walmart to go now for everything.
You know, nothing excites us more than exciting our customers. And we're seeing interesting stats everywhere. Doug mentioned how in Denver, 1 in 4 new customers over the last 6 months were new to Walmart. Here's a stat that was surprising. Even in Northwest Arkansas, where you would think there couldn't be new customers, we're seeing that 1 out of 6 customers are new to Walmart with grocery home shopping. Online grocery makes shopping easier, but beyond that, it solves customers' problems. It gives a busy mom or dad time and helps people plan and budget more easily. Grocery is a volume business, and it's a delicate balance to get the unit economics right, especially with fulfillment. Online retail is hard, and grocery retail is really hard. So online grocery is, of course, really, really hard. And we really, really, really like that. We're uniquely positioned in this space. We have 15 years of experience from the UK and experience now over the last couple in the US. We know how to execute this, and we've got the physical footprint to make it work. We're using our experiences and our resources to execute in a way that makes sense for our U.S. business. And when we hear comments like life-changing and amazing, we know that we're on the right track. And that's also true of mobile. Mobile's about using digital technology to transform the entire Walmart shopping experience. We're providing services that consistently remove friction to make shopping in our stores easier and more convenient. And as a result, 24 million people are actively using our app each month. It ranks among the top 3 retail apps. And one of the great benefits of using the mobile app to change the in-store shopping experience is that we can continuously changing it without a single change in the store. We're regularly updating it with new services for customers, which lets us quickly serve them in new, important, and imaginative ways. The Walmart app solves problems. A customer who wants to refill her prescription but needs to get out of the store quickly, she can save herself time by simply taking a picture of the label. She can pull up the mobile registry and see what to get her friend next weekend for the baby shower. And when it's time to check out, she can get an e-receipt right on her phone. And thanks to Savings Catcher, she knows that if a competitor has a lower advertised price on something she just bought, she'll get that difference back right on a gift card. Again, we're layering new digital capabilities over the store experience to transform the shopping for our customers. And what's especially powerful about services like the mobile app or like online grocery shopping is how they help us form a digital relationship with our customers. And this is an important point, because using a service in-store leads to customers connecting with us in a deeper and more engaged way, and coming into the sweet spot where they're shopping both in-store and online. They download our app. They log into their Walmart.com account, and if they don't have one, they create one. And then we have the opportunity to solve so many problems for them. This provides a gateway for them to shop on Walmart.com, which has way more products than what we can put in any of our stores. There are over 7 million items today, and we're on a ramp to over 10 million this year. And soon, we expect that number to be in the tens of millions. We'll continue to refine our first-party assortment, and we'll also be significantly expanding our third-party marketplace. And that's something our new global technology platform, Pangea, will make much easier. Pangea gives us the ability to radically scale our assortment, and we've used data to make our merchants more productive as we scale. We created smart pricing algorithms that we've now applied to nearly all of our items this year. And when customers come to Walmart.com, they expect Walmart prices, and we're delivering. Pangea helps merchants manage a lot more items than they could under traditional pricing management methods. We've invested in price, and we're meeting or beating our online competitors 4 out of 5 times. Pangea has also simplified shopping across devices. With it, we have moved Walmart.com to a responsive design, which adapts to whatever device you're shopping on. And customers are seamlessly exchanging experiences to get what they need. Imagine during this upcoming holiday season, for example, Dad might put something in his cart while he's in the store on Black Friday, and then he might place the order at work on Cyber Monday. Interestingly, our data shows that almost 15% of transactions on Walmart.com occur across multiple devices. And that number is growing and will continue to grow. And just as we're scaling our assortment, we're doing fulfillment at scale. We're continuously adding capabilities to our supply chain. This summer, we opened new next-generation fulfillment centers in Pennsylvania and in Indianapolis. And 2 weeks ago, we opened one in Atlanta. We will be opening a new center in Southern California in the early part of next year. That adds on to what we already have with one in Dallas, and we'll add another there next year, in addition to 2 more in Florida. These new centers are the size of 20 football fields. They could fit 2 Carnival cruise ships inside. We're using some of the most advanced automation available. Our fulfillment network is unique. We create a little video to show you. Let's take a look.
Walmart uniquely combines digital and physical assets in a one-of-a-kind fulfillment network to reach the customer more quickly and affordably.
Our fulfillment centers are strategically located throughout the country based on customer demand. Just in terms of SKUs, one facility that we're building, just this building alone, will have 5 times the SKU storage capacity that our entire network had just a year ago.
We've invested a significant amount to put a lot of outbound processing horsepower within these facilities and minimize our labor costs to reduce the amount of time it takes to get those orders to a customer.
These large-scale e-commerce fulfillment centers combine with existing e-commerce facilities all over the country. Plus, over 80 Walmart retail locations are set up to ship directly from store.
A customer's order comes in, an associate picks the items from the shelves of the store and ships the order directly from the retail location.
Add that to 4,500 store locations that can be used as pickup points for orders, and you see the total picture of a dense, interconnected network that allows Walmart to get closer to the customer.
Walmart's transportation fleet is one of the most efficient operations in the world. All of these pieces, the centers, the stores, the fleet, work together to give customers more choice in how they receive their order, faster service, and lower cost.
There is no other company with a network like this.
Walmart is doing what only Walmart can do. Walmart, e-commerce fulfillment unlike anyone else.
We've made huge progress, and the real power is in how we've stitched everything together to get items to customers quickly, efficiently, in whatever way is most convenient for them. Customers can have items delivered to their doorsteps or choose in-store pickup and get them as soon as today. We're also testing the unlimited shipping pass service, which is getting great reviews from our customers. We have a distribution and transportation network no online retailer has, and technology that no grocer has. And this brings up an important point about e-commerce and grocery. It's really more than just about online or just grocery. It's about the power to shop for millions of items online, and then to pick them up at our stores or other locations, along with their fresh groceries. We're able to leverage online grocery shopping with the full breadth of our online assortment to solve problems for our customers and help save them time. And when we put it all together, we offer the precision of e-commerce at the scale of retail. We're also providing convenience all across the portfolio. We've made significant strides at Sam's Club this year in building a better member experience. We're doing some big things with Club Pickup, and we're seeing strong results. Club Pickup was up nearly 40% in the first and second quarters this year. One advance is Easy Reorder, which is especially popular with small business owners like restaurant, cafe owners, who need the same items regularly. We've also started testing mobile check-in, which automatically alerts our associates when the member arrives in the parking lot. When they get inside the club, the order's ready to go. We're also focused on growing in China. In China, our combination of brands allows us to offer the Chinese customer access to high-quality items at Walmart prices. We recently completed our acquisition of Yihaodian, and we're very excited about the opportunities it brings. Right out of the gate, we're launching a new home shopping app at our hypermarkets. We're able to do all of these things for customers because we've built an internet technology company inside the world's largest retailer. We've built the team, an incredibly talented group of merchants and marketers and technologists, data scientists, supply chain professionals, and engineers. We've built a platform. Walmart.com fully transitioned to Pangea this year. We built the physical distribution network in the U.S. that we talked about just a minute ago, as well as in China, Brazil, and the UK. And for technology, we're an active participant in the technology community, especially in using and contributing to open source. We've embraced open source in building our platform, and we've built it on the cloud. Using open source helps us build best-in-class technology in a highly efficient way. But we're also inventing and building important new technologies that didn't previously exist, and we're also opening them to the community. Today, I'm proud to share that we plan to open source another piece of technology that serves an important need. We call it OneOps. OneOps is a powerful technology that allows us to use multiple clouds, move applications among those multiple clouds. It's made our developers significantly more productive, and it helps them deploy product enhancements much faster. Clouds have today what I call the Hotel California problem. You can check in, but you can never leave. So we're open sourcing OneOps because it will allow others to move freely from cloud to cloud. We don't think anyone should be trapped in just one cloud. OneOps should create competition and should lower the cost of cloud services for all of us. So in closing, we built an internet technology company inside the world's largest retailer. And an internet technology company isn't really about building technology, though. It's really about customers. We serve one single purpose: helping customers save money so they can live better. And living better takes on new meaning as we're now saving customers time and solving more problems for them. We've delivered a lot this year to enhance our customer experiences online. From moving Walmart.com to the new platform and scaling our assortment, to adding those large-scale fulfillment centers that I showed you. And it's paying off. We've doubled the size of the business over the past 3 years, and we are continuing to grow. We expect to grow faster than the market, between 20 and 30% over the next 3 years. And that number assumes continued growth in the U.S. and continued economic challenges in some of our larger international markets. With the foundation and scale created in our global platform and fulfillment, we expect that our investments will moderate over the next few years. And that provides a path to profitability in our largest e-commerce markets and the ability to leverage investments around the globe. But it's so much bigger than just e-commerce. As we expand e-commerce to also include grocery shopping, and as we bring the power of mobile to the store, we're seamlessly connecting the digital and the physical worlds. It's how we're serving our customers in new ways to create deeper and more trusted relationships. And it's how we're growing the entire company. And as excited as I am about all that we're doing in e-commerce, I'm also excited about what Greg is doing with the stores in the U.S. So with that, I'm pleased to invite Greg up to share some of the progress that we're making in the U.S. Greg?
Good morning, everyone. It's good to be back in New York with you. Today, I'm going to begin by just giving you an update of some of our progress to date. Then I'm going to segue into our strategy to win in the US, and then finalize with you how we'll run the business to deliver on that strategy. When I spoke to you last October, I told you that my goal for this current year was to improve the core, the stores, and to return the business to comp sales growth. And we have. We've been hard at work, and we're just starting to see some green shoots. As I get around the stores, I'm seeing associates taking more ownership of their jobs. And I'm seeing that regularly. There's a sense of momentum starting to occur within the business, a changing attitude across those on the front line serving our customers. Comp sales are up, and so's traffic. Unit sales are trending north. Customers are beginning to like what they see. You know, in February of this year, we challenged all our stores, and we have 4,597 of them, to improve their clean, fast, friendly scores. And we wanted them at a particular level by October the 1st of this year. Well, we've made good progress. In February, only 16% were at their initial goal. We're now at 67. I want to be clear, we've still got lots of room to improve. And we've already put another line in the sand, and we've raised the bar higher for where we now expect them to get to. The good news is that we've found a really good correlation between the higher your score is in clean, fast, and friendly, the higher your sales. the more traffic you get in, and the more satisfied customers. The other thing that we're starting to see is an improvement in our Net Promoter Score, meaning that more of our customers are starting to speak positively about Walmart. Now, I personally find this measure to be really authentic, and I'm encouraged. Again, we're not where we need to be, but I am pleased with the trajectory we're starting to see. You know, if you haven't been into one of our stores in a while, let me describe what you might find one busy afternoon. In the main, I think you'll see we've got clean floors. We've got better fresh. Pickup is newly branded, and customers can clearly identify where they need to go to find items they ordered online. There's a better in stock. Store managers and department managers are visible on the sales floor. Associates are more friendly, they're wearing their vests, and they've got their new name badges on that say, "Our people make the difference." We're proud of the progress that we're making, but we know that we still have much, much more to do. From a top-line perspective, we know that we've also got some tailwinds from fuel prices, but that is being offset by deflation in food. Operating profit is being pressured by margins in pharmacy, increased shrink, and associate hours. So in pharmacy, we've got several work streams in place right now that are working on building new systems and tools to help offset some of the reimbursement pressures that we are seeing and we expect to see in the foreseeable future. When it comes to shrink, we're tackling that in 3 ways, using technology, analytics, and best practices, including training. I'm confident that in time, the plan we have in place with shrink will turn that into a tailwind for our business. So with that update on the business, I'll expand on what you've already heard this morning and share more about our strategy for winning the US. A strong performing US business is key to the future success of the company. We are, as you've already heard, committed to sales growth. We will invest to grow the top line faster than the market, increase market share, and deliver shareholder value. To grow, we must invest. We are a strong, profitable business, but we know that we can't solely focus on short-term profitability if we're going to win the long term. And the marketplace has changed. The majority of our competitors, including hard discounters and online competitors, are investing in the US and pursuing growth. So we must adapt and grow as well. So we'll invest now to improve the experience and grow the top line. That will allow us to buy for less. We lower the cost of goods, which in turn generates savings, and we invest that in price. Lower prices see an increase in traffic and basket, which in turn grows sales and gain share. I want to be very clear. Our investments do have a timeline. We've got a detailed, well-resourced, strategic plan with disciplined work streams and a cadence of reviews. These will enable us to clearly deliver our financial goals, our growth aspirations, and shareholder returns. We know what success looks like in terms of unit sales, in-stock, and customer experience. We're building a solid foundation to serve customers now, from which we can grow, create a seamless shopping experience, and win the future of retail. Now I'm going to walk you through how we'll do that. The first part of the company strategy that Doug outlined this morning is win with stores. So I'm going to share with you what we're doing to provide an excellent in-store experience right now and in the future. As part of that, I'll talk about our people. Our incremental investment of about $1.5 billion in our people next fiscal year is a really large number. But we're confident it is the right thing to do and essential to building the best talent in retail. Then I'll walk you through what we're doing in 3 of the growth areas that Doug identified. Firstly, value. Low prices have always been a key differentiator in the marketplace. As we invest to grow, we will invest in price, and we will never compromise on quality. 2, be great merchants. Assortment is the lifeblood of our business. We're using data and analytics to determine what our customers want. And 3, convenience. We're uniquely positioned with our large footprint to provide seamless access to merchandise across all channels. So first, we'll win with stores. To do that, associates need to have tools to do their jobs better. And as we've invested in customer experience this year, we're improving the way we work. And we're moving pretty quickly out there. Improve technology. You know, we gave all our store managers tablets in August of this year. All department managers now have handheld mobile devices instead of telzons. Both devices provide real-time access to information key to store performance, and they've moved associates and managers from the back room to the sales floor where they're now serving customers. We've simplified processes. We've reduced modular changes. We've been disciplined about feature displays. What you receive in the back door is what you've got to be able to fit on the floor. We've pulled back significantly on advertising tabs and stopped co-op marketing. Our in-stock level is improving. Through a focus on replenishment, we have moved thousands of items to overnight delivery. We have something called top stock in neighbourhood markets. That's where associates can just simply reach to the stock on the top shelf instead of having to go out to the back room. Early indications as we roll this through every neighbourhood market are really promising. We're seeing a reduction of inventory in stores and improved service levels. We'll roll that out to all supercenters by May 2016. As well as that, our supercenter inventory process is streamlined. We used to have IMS. We now have a new program. It's called Customer Availability Program, CAP for short. It's resulted in inventory reduction in stores and better availability for the customer. When our associates combine CAP with the new technology we're giving them, there's a 50% time saving in the back room, 90% on the sales floor. It's simplifying their life. We're also optimizing flow. Our objective is simple. Merchandise should only ever move one way in our business, from the back to the front and then out the door. We've also been hard at work at redesigning our supercenters and neighbourhood markets. Let me share a few details with you. Supercenters are a strong, profitable format. It's the best in the world, in my view, but we're working to make them even better, to meet changing customer needs. So we're continuing to moderate our supercenter build-out next year to ensure long-term success. We'll build 50 to 60, which includes relocations and expansions. We've done a deep dive into what the customer wants, and we've found that the top drivers of customer satisfaction are fast checkout, ability to easily navigate the store, a relevant assortment, and products in stock. We're piloting and testing lots of changes, which is fun. And we're going to take the very best of what we've learned and we'll retrofit that into our fleet on an ongoing basis. New stores will also reflect the changes. But of course, the supercentre is more than just a store. As we further integrate with e-commerce, it's about the offering the supercentre provides. Pickup, online, fuel, and of course, great merchandise at our everyday low prices. Actually, today is the grand opening of our first redesigned supercentre, which is in Rogers, Arkansas. I wish I was there. But you would see if you were there that we're in mode and we're beginning to test the first phase of our changes. So let's take a look at a video of what we've actually done. It's the first one we've got down. I'm pretty pleased actually with where we've got to. If we were actually standing in the store today, as you walked in, I think you would notice things like an improved vista across the store. It's actually pretty easy to navigate when you're in the store. So it's obviously a bit lighter, a bit brighter. Really pleased with how fruit and veg has come up. We're testing some things there in deli. We've had a look at assortments. There's some extra items in there in terms of fresh. You would have picked up on the video that baby becomes pretty important for us. It's got an increased footprint, it's got increased assortment, but we're really leaning into how we now get close to the .com opportunity. So obviously we're rolling Wi-Fi into all our stores. We've not only got, roughly 120,000 SKUs available in a supercentre, but of course there's many millions more online you can order anytime you want and have them shipped to the store for free. Even things like automotive, I'm really pleased with the progress I'm seeing there, and we've just made some important customer changes to how that looks. And of course the front end, and we'll continue to test and have a look at what we're doing with things like scan and go and self-scan and belted self-scan, but I like some of the changes that we're seeing there, and you'll see components of this getting rolled out reasonably quickly as we move through into next year. So now to neighbourhood markets. And they're just such a terrific complement to a supercentre. And we're running them better. And we're confident that they're uniquely positioned to compete. We'll moderate growth this year and build 85 to 95 new stores. And that's deliberate as we focus on improving profitability and the productivity of this format through enhanced fresh and access to services. We're working to make them more inviting and to get them in the right locations relative to supercentres. And these are some of the photos of our newest store in Rogers, and you might recall in Doug's presentation he had that photo of the fresh. That actually, as he mentioned, he tweeted that out. That is from the new Rogers store. So we're excited about some of the changes that we're making to this format. And doesn't pickup make neighbourhood markets unique? What other supermarket offers you access to millions of items online. Customers love the convenience, the fresh, access to fuel and pharmacy. And for those who are interested, we'll show more of the new store in Rogers later through a virtual tour after the Q&A. And before you leave, you'll all receive a virtual reality headset, one of these, to take with you to experience the tour on your own. Finally, when it comes to stores, winning in stores, our people are essential. Our theme this year is that our people make the difference, and they do. And it's why we're holistically investing in wages, providing training and more flexible hours for them. In addition to raising the facility start rate for current associates to $9 an hour this April, $10 in February, we have also rolled out structural changes this summer. We've added in the last few months 8,000 department managers who are empowered to run their departments and be great merchants. Next year, we'll roll out Pathways trainings programs that will be giving our people better training and a clearer understanding of what they need to do to get promoted. Our associate engagement scores are up. And even though the scores have been at or above industry benchmarks for several years, we're proud to see an increase this year after remaining flat for the prior 2 years. Now, frankly, it's too early to report any more than this on our investment in people. We'll know more after we've rolled out all our changes. But I can share with you anecdotally that what I'm seeing as I get around the country, and I'm out in stores every week and most weekends, I'm seeing improvements. I'm seeing and hearing from our teams in stores that they're better able to recruit and retain talent. The momentum is starting to shift. It's pretty simple, isn't it? In my experience in running businesses, if you pay your people competitively, if the managers are really engaged and they're good, if you train people, you give them the right schedules, you're going to see happier associates. You'll see a marked improvement in the shopping experience, and you'll get a return on your investment. So that's how we'll win with stores, and we'll deliver a great shopping experience. Next, I want to talk about value. Walmart has and always will be about value. Low prices have always been a key differentiator in the marketplace. This year, we made a strategic choice, and that choice was simple. We're going to invest in the store experience first, including our people. And as we fix the experience, and we are, you're going to see us start to invest in price to ensure that over the long term, we deliver on the low price promise our customers expect. As Charles mentioned, our plan to invest several $1 billion in price over the next 3 years is included in our guidance. To deliver value and our low price promise, we remain focused on lowering costs in the way we operate by running a better business, and also in how we procure merchandise. So I'll share 2 examples that demonstrate how we're doing this. Firstly, our markdown initiative, which is part of Urgent Agenda that I've spoken about previously. We've reduced markdowns. We continue to reduce markdowns on damaged goods. Here's how it works. If a Halloween princess costume is missing its crown, our stores will mark it down to a lower price instead of just throwing it away. A customer's happy to get the great item at a lower price. Secondly, through better buying, we deliver cost of goods savings, which in turn, we invest straight back into price for the customer. Next, we'll be great merchants, and we'll win with the right assortment. It is the lifeblood of our business. Grocery is clearly a larger part of the business now, and we're pretty focused in this area. But good grocery starts with winning in fresh. And as some of you know, I spend a lot of time in my store tours in fresh. It's an area I enjoy teaching, touring with associates. We also know that fresh is a traffic driver. The quality of our fresh and our fresh reputation is a key focus. We have to earn customers' trust. So we've sequenced a plan to win in fresh by getting the basics right, building on that, and ultimately transforming our fresh from the farm to the checkout. We'll do it with much better assortment, much better execution, much better processes, and a great supply chain. Now, we've got lots of work to do, but I can tell you customers are starting to notice a difference. In the last 52 weeks, market share in fresh is up 26 basis points. Unit comps have improved 1.5%. Markdowns are down 70 basis points since last year. Our price gap in meat is up 200 basis points versus last year. And we also know that the large majority of our customers would purchase affordable organics. So our organic offering continues to expand, and it's now much easier to find on shelf. We're also focused on providing healthy snacks and easy prep meals. We'll keep driving hard towards our ambition to save people money so they can eat better. Next to private brands. Let me be clear. We have always been a destination for quality national brands at everyday low prices. And we will remain, first and foremost, a national brand retailer. We know that our private brand customers are some of our most loyal. But private brands are key to addressing the price gap with hard discounters. They are critical to our growth aspiration. So we've doubled our private brands team, and our focus remains on delivering quality, innovation, price, and ultimately increased market penetration for our customers. So we've got key work streams in place to ensure a well-defined brand architecture. We've got teams to develop and identify assortment gaps, extend product lines and innovations based on what we've learned from customers. And here's what's interesting. As customers become Walmart private brand adopters, they also spend more trips. They make more trips and they spend more. In fact, of this increased spend, half of it is on non-private brand items. This means that as customers become more engaged with private brands, they become more engaged with Walmart overall. So we're excited about the opportunity. Overall, you'll also see us bringing discipline to our assortment in grocery and the total box. We've got data from 80 million households. We're introducing new capabilities to give merchants the tools they need to develop an assortment that fits the way a customer shops. This includes advanced decision trees, dendrograms, measures of loyalty, substitutability, and improved store clustering analytics. Now, we're already underway in 7 categories. We're testing the results. Our plan next year is to address a further 76 categories and the remainder the following year. Finally, to convenience. As customers value convenience more than ever, Walmart has a distinct advantage with our large footprint. We can offer customers seamless access, enabling them to shop whenever and however they want, in store, online, or via mobile. We know that customers who shop across all channels spend more. Doug showed us that. It's the sweet spot that he referenced. You can see it here. It's in play now in some of our stores. The ability for the customer to use their mobile, even while they're in the shop, scan that item, identify what they want, ship it to the store, pick it up. Next to online grocery, an associate loading groceries into a customer's car. It could be me. I often use the grocery pickup on the way home. Customers love the ability to order their groceries online or on their phone and pick it up when it's convenient. We know that the basket for customers who shop online is 2 times the average supercenter basket. And that many online grocery shoppers are new customers to Walmart. So we're gaining new Walmart customers. We're excited about the potential here. Pickup has been a priority this year. Customers love it when we do it well, and we're always working to make it better. In fact, pickup foot traffic this year is up significantly in neighbourhood markets. Let's have a look at the advert that will start to run next week.
Pickup?
In the back.
I ordered this online?
Yeah, let me have a look.
Thanks. Hey guys. Hey, Bobby! Nice, right? Yeah.
Buy now, online, or through our mobile app and pick up in store.
Happy birthday, honey!
Because every day is an opportunity to make your day better. Walmart.
So you'll see that start to hit the airways from next week. We're also, as we speak, hiring an additional 3,500 department managers who will be working in pickup for this holiday season and beyond. We need to do that so that we really make this a fantastic opportunity for everyone. Here are a few customer comments about pickup. It's easy, it's convenient, it's fast, it's free. I was in and out. So we're excited about our offering in store, but the real power here is when you take the world's biggest retailer and you connect it to a digital platform. We will be, as Doug said, the first retailer in America to offer a seamless shopping experience at scale. So where does that leave us? As we've discussed, we're focused on growth, specifically on driving the top line. And we've returned the business to positive comp growth this year, and we expect that to continue. Over the next 3 years, we anticipate a 3 to 4% total sales CAGR. We've proven this year we can grow the business, and we'll continue to do so. But to drive this growth, we must invest in the business, and that will slow our profits for a bit. As Charles discussed, our investments in our associates, e-commerce, grocery, online, and pickup will hit their peak next year. We expect these investments to slow the US operating income in FY17. Looking forward, though, as our investments wind down, we'll see operating income grow faster as we continue to drive the top line and we get the productivity loop turning again. By FY19, we expect we'll be back near our FY16 operating income dollar levels. However, we know that that growth will come with a different mix as customers shift between formats and our sales continue to move towards grocery and e-commerce. Our customers' changing needs will affect our operating margin rate, which we expect to remain below previous levels. But you can be sure that we will succeed in our efforts and will drive the shareholder value you've come to expect from Walmart. So to sum up, there are 4 key takeaways for you today. Firstly, we have a strategic plan in place to deliver top-line growth and deliver shareholder value. 2, our investments are paying off, but will take time to complete. 3, metrics of success are identified and being tracked. And finally, we are uniquely positioned with our footprint to win across all channels. Thank you. Now I'd like to invite Doug back up to make some closing remarks.
So, this company is now over 50 years old, and retail has changed, and retail is going to continue to change. And in our case, it's not enough just to run it well. We have to change it at the same time. And to change it, you have to make strategic choices and invest in those choices. The great news for us is the assets that we already have, our stores, our distribution center, our great associates, are still relevant in the future. But leaning into investments on people and technology, and in these next few years, intelligently into price, will create the situation that enables us to win in the future. And that's the transition that we're going through. For us to deliver for shareholders, we have to first win with customers and win with associates. And that's what we're choosing to do. And we look forward to answering your questions about that. But first, we want to feed you. And I'm going to ask Pauline to come up and tell you about the logistics related to that. And then we'll be back up in a few more minutes to answer any of your questions. Thanks, Pauline.
All right, for lunch, if all of you could go to the back of the room and go to the right, there's a buffet line set up. If you could get your food and then come back into this room, we will reconvene in about 15 minutes to have questions. as you receive the mic, if you could please state your firm and your name so that we can have that for the folks that are participating on the webcast. We have Carrie and Michael who will have the mics and will be going around. So we'll go ahead and start, Simeon.
Hello?
There you go.
Simeon Gutman, Morgan Stanley. For the guidance for fiscal 17, you showed EPS down 6 to 12%. I presume that includes buyback, which implies that EBIT dollars are going to be down somewhere in the 11 to 17% range. If we back into that on a dollar basis, it's several billion dollars of EBIT dollar decline. We talked about wage investments again, $1.5 billion. We assume the e-commerce losses stay around $1 billion. That leaves still multi-billions left. I presume that's the price element, and then there's a wide range around that. Are there other pieces, and can you sort of give a little bit more clarity if the dimensions of that are exactly?
Yeah, I'm not sure about your several billion. You're talking about FY 17 earnings per share? Is that what you were asking about?
Yes.
What we said is 75% of the decrease is related to the $1.5 billion in wage and store structure. So you can do the math from there. So it's not several billion beyond that.
And e-commerce and price would be the two other components that we would point to that continue. And as Neil showed you, the e-commerce profitability trend starts to improve over time, but it is that overlapping of the wage investment and these other investments at the same time. And we're trying to give ourselves some room as it relates to price. We can talk more about that if you guys would like. I think that's one of the key questions that I'm sure you would have on your mind. I just want to underline the wage decision that we made at least one more time. This is a big investment in people. Between the 2 years in particular, it's significant. And I don't want people to miss that. And I think the 75% number that Charles mentioned needs to be well understood. And I guess I can relate to the fact that when we announced this change, which was back in February, both the $9 and the $10, that many might not have done the math or understood how to do the math, and maybe we didn't give you enough information to do the math on the $10 jump. But together with those starting wage rate changes to 9 and 10 and the other investments that we called out, it was clear that was a big number. I still, looking back, feel like that was smart. I think that was the right decision to make. In some ways, it demonstrated leadership. In other ways, it's a market reaction. But the outcome is that our associates deserve that wage increase, and the performance that we will get from them and the relationship that we have and will develop with them going forward is a key strategic choice. This business has been about people, and in 25 years it will be about people. Different skill sets in some cases, and clearly technology has changed retail. But this associate investment is one that I hope people will really take the time to understand. It's of strategic significance.
Michael?
Hey, Rob.
Morning, Robbie Ohms, Bank of America Merrill Lynch. Your stock and a lot of retail stocks are down. You gave us this sort of down up on the, on the earnings outlook, and I get all the investments and everything. Can you just walk us through the same-store sales expectations, and how are same-store sales trending now? And what is the assumption for U.S. same-store sales, over the guidance you gave us today?
Yeah, Charles, maybe you and I comment a little bit, and then we'd ask Greg too, I suppose. But we've given guidance.
Yeah, back in the second quarter, we gave guidance to what we thought would be in the third quarter. We're not here to give guidance today for the quarter, Robbie. But you did hear Greg say that he expects that he's done a great job with his team at getting his traffic and comps up in the Walmart U.S., and he expects that will continue.
I think one thing I would add, Robbie, is that it's important in the comp number to think about the components. We've got a supercenter comp number. We've got a neighborhood market comp number. We've got an e-commerce contribution to comp. What we don't know is what will happen with inflation, where will fuel prices be. We have some assumptions, obviously, around those numbers, but there are a lot of variables that go into play. I think, Greg, you should talk a little bit about the store experience, because the only way to get sustainable comps is by really running great stores. We need a great experience with our customers. We need strong merchandising. There are a lot of pieces that go into making that happen. And I think you can look at the steps that we're taking and understand how they dovetail on each other to create that situation.
Yeah, it does. It sort of feeds into your first point, and also in terms of what we're paying our people. You know, it's interesting as I get around our stores, most stores are now actually starting to pay bonuses for their associates, what we call my share. It's a big deal, and one of the reasons is that sales are hitting what we expect, and also to get Clean, Fast, Friendly linked in, we actually tied that into my share. Makes a big difference to our associates when we're recognising them where fixed starting rates, the stores are starting to bonus. And that in turn is creating better stores. Now the reality is, and the numbers show it, as I get around the stores, Doug, 2 out of 3 get a pass mark, 1 out of 3 don't. 67% have got Clean, Fast, Friendly. And just because they've got a pass mark on Clean, Fast, Friendly doesn't mean that they're great super centres yet. You know, I'm guessing we've probably got 300 or 400 out there that I would really rate as a fantastic shopping experience when I walk them. Then we've got a whole group in the middle that have improved, but we've got room to go further. There is no doubt in my mind that as you improve the shopping experience, the comps improve. You know, I'm in Olive Branch in Mississippi on Monday morning, 7:30. The manager's got no idea I'm going to turn up. And I walk in the store and he's standing there, he's got his iPad, department managers are working, they're engaged with their MC40s, the handhelds. And he's come off a 7% comp on Sunday. He's got a business which is running a 4.2% comp year to date. And you can see it when you walk the store. I can equally go into stores that haven't got positive comps and I can see why. It's a store-by-store thing. There's lots of opportunity for us to get better and improve. And, you know, inflation will be what it is and other activities, but I know that we can grow the top line in this business, and we are.
We had a good laugh with Greg. He knew he was in Olive Branch, but he wasn't sure if he was in Mississippi or Tennessee, so we finally figured that out.
I do know the capital of North Dakota.
That's good.
Carrie, next question.
Paul Trussell, Deutsche Bank. Just want to follow up on the comp question. And Greg, I do appreciate your comments, but I think there still is a little bit of a disconnect on the 3 to 4% sales CAGR expected in the out years for the Walmart U.S. business as you are reducing the growth of stores. If you can just help us make that connection, particularly on the grocery business, which I believe in the last quarter was still comping flattish, and obviously being the bulk of your mix needs to really take a meaningful tick up in order for you to achieve your goals. And similarly, Neil, you outlined a 20 to 30% CAGR on the .com business, yet in the second quarter, we just saw a deceleration to the mid-teens. Help us please connect those dots.
You know, as Charles and Doug have said, you know, we've given the guidance. You know, I'm not going to do anything other than say I'm pleased with the momentum we're seeing in the business. Doug mentioned general merchandise previously. Food, I'm also feeling better about. We're seeing more traffic, so we've got more customers visiting our stores. We're seeing an improvement in units, they're trending north. And I know that we can build on the momentum that we've got. 3 to 4% total sales CAGR is what, you know, I and my team have signed up for, and we know that we can do that.
And this year, remember what I said, Walmart U.S. should do around 3.5% this year.
Yeah. And on food, Greg, you might want to talk a little bit about the opportunity in fresh and the inflation-deflation arrangement in grocery right now.
Yeah, sure. So fresh, clearly, you know, there's opportunities for us to do much better, you know, assortment, pricing. As I get around and I look at what's happening with hard discounters, I see opportunities. A lot of work underway in terms of grocery. We've identified to you that we will invest in price, and we're going to. We know what we want to do in that area, and that's built again into our guidance. But we're already seeing some momentum, and I'm really happy with how the grocery business is going. Share is going well. It's not startling, and you wouldn't expect it to be. This is a really big ship, and you've got to deal with it one piece at a time. But we've got some momentum, and we'll hold on to it.
Paul, on the e-commerce side, I'd remind you guys of what I said at the end of the second quarter, which is that we've had pretty good growth in the U.S., both at Walmart.com and as well as at SamsClub.com. That's been inhibited by some challenges in our larger international markets. And just for context for everyone, the largest international markets for us are the UK, Brazil, and China. And so it's obvious the competitive and economic issues that are going on there. So as we think about, and anytime you're going to give 3 years worth of kind of revenue growth guidance, you're going to have ups and downs along the way. And so we expect there to be ups and downs along the way. We expect the U.S. to continue to perform well, both the U.S. and Sam's Club. We're obviously adding grocery, which is basically a whole other line of business to the U.S. business to grow that. And then we don't expect the conditions to remain the same in the U.K. and China and Brazil forever. We can't control those, of course, but we don't expect those to go on forever. So we feel pretty good. And the story is very similar to Greg's, which is that the wheel's turning. So we've got the traffic, we're adding the assortment, we're adding the lines of business, and we're starting to see customer performance and frequency and other key metrics start to improve. So it's anytime you give long-term guidance, it's hard, but those are the breakdown of the components.
Okay, Michael, next question. Also, if you're asking the questions, if you could please stand for purposes of the webcast so that they can catch you on the camera.
Hi, Matt Niemer with Wells Fargo. So I have a question about customer lifetime value when somebody goes from being a moderate shopper at Walmart 5 times a year to a moderate shopper online. I understand that multi-channel customers end up being great customers and they're very engaged, but on the more moderate side, what happens to lifetime value if somebody goes from the store to online only? Thanks.
So store to online only, not multi in their relationship. I don't know that anyone...
We haven't seen that behavior, Matt. So, it's an interesting question. Doug outlined, and Charles, the evolution of the business. So as we add e-commerce, obviously we're adding a business that's a lower operating income margin, but a higher return, so less capital required to run that business. And so we're starting to see that mix out. But what we're seeing with customers is that they're better Walmart, the brand Walmart customers. And so that's why we steered into what Doug called the sweet spot. And you can see that performance. We're not seeing a trade-off. We're seeing an evolution and a growth.
Okay, Carrie.
Hi, it's Michael Lasser from UBS. So you outlined investments for next year. Operating margin is going to be down. What will drive operating margin expansion after that? And as part of that answer, can you talk about how the model is evolving? Part of what's happening with Walmart is the cost that historically have been burdened by the customer, where they're walking through the store, picking products off the shelf, checking out in the aisle, or paying for shipping, is now being burdened by the company. And how is that going to impact the company's long-term profitability? So both of those are questions. Thank you.
One of the reasons why the margin improvement gets better is because we don't anticipate the significant wage investments that we were making this year and next year in the go-forward plan. The market, as it relates to wages, will certainly ebb and flow over time and will respond appropriately, but the amount of the investment and the amount of our adjustment won't be anything like what we're doing in these 2 years. So it springs back the sheer nature of that. And then number 2, the e-commerce margins continue to improve. Profitability as it relates to the trend of e-commerce improves. Your question about picking orders for customers is a really good one, and we studied it closely in the UK. And as that business went to delivery in the market, you may be aware the grocers went from a store to a store plus delivery business and then backed into pickup. What we found was the returns related to delivery took a long time to mature. It's very difficult to make money delivering food. But the pickup aspect drove returns up quite quickly relative to delivery for sure. So what we're positioning ourselves to do is to win with the customer in this seamless environment. As we mentioned before, they won't actually think that much about whether or not it's in the store, picked up or delivered. Over time, they're just going to think I'm shopping at Walmart. And it's through that blend of the relationship with the customer that we'll be able to generate strong returns. So it's not just looking at it in isolation, although pickup itself has a nice return. It's also looking at the overall relationship.
Bernie Sosnick. My new affiliation is Madison Global Partners. With regard to neighborhood markets, I have difficulty reconciling some of the points. Same-store sales growth has been strong, which would imply improved profitability, and yet you said that you're slowing the growth rate for neighborhood markets because profitability has to improve. You were not satisfied with some of the stores that opened over the last few years. Could you give us a synopsis of where neighborhood markets stand?
Sure. So we've got, you know, if you include the 100 express stores now, we've got, you know, circa 500 plus neighbourhood markets. And we've got some that are very mature and some that have recently opened. So you get quite a difference in performance based on the maturity of the store. And you also get quite a difference in performance based on who they're up against in terms of their competitive set. So to be completely candid, when we are up against someone who is really good at running supermarkets, frankly, our fresh offering has not been on par with what it takes to win in those environments. And if we're opening stores where the competitor is not particularly strong, then generally we will do pretty well. And a lot of that is driven by some pretty significant price gaps that we can generate. So, you know, we need to fix what we do in fresh. We need to make sure we do a great job with the services, whether it's grocery, home shop, whether it's pharmacy. And so it's appropriate that we be pretty thoughtful about where these things go, and we get that model working right, and we make sure that we get them located exactly where we want to get them located. We get gas on them wherever we can. We get them the right distance away from supercentres. We get them on the right side of the road, all those sort of things. So, you know, I'm really excited about what we can do with neighbourhood markets, but we've got to fix some of these basic things, and then we can get into them.
Carrie.
Thanks a lot. Matt Fassler, Goldman Sachs, and good afternoon. My primary question relates to the incremental investment for 2016 or your 2017. Can you map that to the math of the wage increase versus other investments that you're making in the store? How much of it is the shift to $10, and how much incremental additional material is there, additional drivers contributing to that increase in investment?
I'm not sure whether you're asking about the wages versus other types of people investments or wages versus price. The number for the total investment, 75% of next year's total, is related to people.
I'm focused on next year's investments, which I understand are primarily wages and labor.
That's correct.
Right, 75% of it.
And is all of that just wage rate, or is there a portion of that that's also related to incremental investment in hours or structure, et cetera?
Thanks, got it.
Yes, so that includes what we're doing in terms of department managers and pickup and getting grocery home shop rolled out to many more markets. So that includes that total amount.
Michael.
Thank you, Oliver Chen from Cowen and Company. As certain pure plays focus on the consumables and apparel markets, what would you say are your competitive advantages in terms of how you work with vendors and how you think about how vendors may play a role and as you elevate the seamless customer experience? Also, on the supply chain side, on some of your earlier comments, just curious about what you mean about improving accuracy and driving sustainability? What are the key elements of that? And just lastly, on the price investment side, which categories are you focused on with the biggest opportunities in price investment? Thank you.
You may take supply chain, you take the other two. The world of retail is moving to more of a pull system than a push, in that as customers use a website or a mobile app to tell us what they're looking for and what they want, that increases our accuracy as it relates to how we choose to flow that item to a customer and how we anticipate demand. And with today's opportunity with predictive analytics and frankly some of the tools that Neil and his team are starting to develop, point us towards a time where our forecast accuracy could go up, and that's going to be one of the keys to winning. And as we mentioned before, having a supply chain that is connected and more dynamic will help us take out costs. And it's not just transportation and handling, but it's also markdowns. So today we have a distribution system that was largely built in silos. We bring in import goods, they go to an import center. We have grocery centers that handle high turn goods. We've got other distribution centers that handle non-food, general merchandise. We've got apparel centers, and those act independently for the most part. When you start to connect them and you have a good forecast, the path that inventory follows through the system will be the most efficient path and take more costs out. So you could just imagine a big regression analysis, a big optimization of a network. And we have more nodes and distribution paths than anybody. So our ability to optimize across that network would be superior to others because of the fact we've already laid down that network. It's a lot of work. And in some cases, building new tools will be needed to make it happen. But I'm really excited about it. I can imagine what that's going to look like in the future, and we're starting to make it happen today.
First question was, I think, around apparel and consumables and our relationship with suppliers and opportunities there. Both those areas continue to perform well. In the case of apparel, you know, I'm actually really encouraged by what I'm seeing there, despite the fact that it's incredibly warm outside at this point in time. I think our team there, Andy Barron leads it, have done a very good job of basically putting together a good package. Now, there's room to improve that, but I think we've got into opening price points. We've got a good relationship with our suppliers. We're buying at source. You know, he's simplifying the operation. I think there's still room to go. And, you know, we've got to do better work in terms of flowing merchandise. But apparel is going well. I like what we're doing there. Consumables, likewise, is also performing, and that sits under Michelle. And she's working closely with our vendors there, large, medium, and small, to once again simplify the business. To get the modulars going right, to get the flow right, to get the in-stock performance right, working on price, sorting out the role of private label in these categories. Consumables is a good bellwether for our business. It drives a lot of foot traffic, always has, and it probably will continue to do so in the future. So both businesses going well. What was your third question, sorry? Yeah, okay. So, you know, we've outlined that we'll be investing billions over several years. We've got a good plan as to how we want to do that, and you'll see us get into that. I don't want to get into the details of that for competitive reasons. You know, you can trust that we're pretty close to price. I know what the price gaps are. I know what they are on national brands, private label versus competitors, you know, regionally, nationally, and we really want to get after this. We know it's part of our heritage, and it's going to be important in terms of the overall plan of driving sales growth, and that's really what makes our business work. You get the top line going, and that then forces the productivity loop to turn. And so that's why, you know, you've got to fix the stores. You know, your words are you've got to sort of get the house cleaned up before you invite the guests over. We then have to get in and sort out the price. And we can get this business moving. And of course, you then link in what we can do with Neil's organisation. And I think we've got really good competitive advantage. Now, we'll get 1 point for talking about it and 9 points for doing it. But we're after it. We know what we have to do and got a plan, it's sequenced. We've costed it out. Now we've got to do it.
Carrie.
Thanks. Chris Horvers, JP Morgan. Can you share a little background on the experience in the UK with the hard discounters? What was the price investment that was needed to close the gap there, and how did that impact profitability versus, say, the delivery shift? And then as you think about the billions of price investment in the U.S., is there a gap that you're trying to close versus them, or is it more a defensive tactic?
Yeah, great question. I think all of us have talked about that a lot, so some of the other folks may want to chime in too. But I think the first thing I would remind us all of, Chris, is that it's not just price, it's also assortment. And when you think about the role of private brands and house brands, one of the things that Greg and the team is working on, and the team in the UK is working on, is do we have the right specs in the right position to compete? And sometimes that takes a little bit of time, but you have to address the assortment issues. There are also key questions to be answered about produce specs, what you do with fresh meat. So it's a combination of fresh food and private brand assortment that have to be addressed. And then on top of that, the price investment's got to be at the right level. On top of what a hard discounter offers, we have obvious advantages. We've got a broad assortment. We're building an e-commerce business that's complementary. The store experience is going to be different. There are service areas in the business where we may do things they don't do. So the total package will matter, and we will talk about that with customers as we go forward. The amount of the price investment, both in the UK and the US and in other markets, needs to be managed very thoughtfully and not all at once. And I had a question not long ago from one of you about, well, why don't you just take a big investment in price, hammer down, put it all in right now? And my response to that, and the way that we feel about it, is we have some time to get that right. And if we tried to do it in a really arbitrary way, we'd have some theoretical basis for why it needs to be at a certain level, chances are we'd get it wrong. And what we would like to do is to use this time period that we have with all the work that's going on assortment and other things to navigate ourselves to that right level. And for competitive reasons, I don't think we'd be a lot more specific than that. But I think hopefully you can tell from this response that we've thought that out. We understand what it is that we've decided that we're going to go do, and we will do it over time. And we'll balance what shareholders need with what customers require of us and the whole piece as we go. We get to make pricing decisions every day. Ton of variables, a lot of items, a lot of movement, geographies, ton of variables to play with, and we need to do that, intelligently, and we will. Did I miss anything?
I think you covered it well. Private label becomes key to it. The other thing that's important in the hard discounters is how they play general merchandise. And it's often referred to in the club stores about creating a treasure hunt. That's also something that the hard discounters are good at doing. So it's not just getting your food offer, which includes fresh and meat. It's also ensuring that you keep really relevant in terms of fantastic general merchandise.
Right.
Yeah, it's interesting when we get together. Dave Cheesewright has had good experience at this. You can tell that I'm not from Arkansas in Australia. Have a look at the market in Australia and have a look at what Aldi has done in Australia. I have got to know them pretty well. I've had to compete against them. We'll have another hard discounter opening here in a year's time. And I'm looking forward to the challenge. And we know what we've got to do. Now we've got to get on and do it.
That point about general merchandise is a big one. Star Wars has been huge for us. Pioneer Woman, this Ree Drummond product that we just launched, blowing out. The breadth of assortment and the fun that you can have in a supercenter for customers is there, but we have to manage the assortment and the pricing in such a way that there's not a trade-off for them.
Michael.
Great.
Thanks. Hi, it's Greg Melick with Evercore ISI. I really had two questions. One is, Greg, on going back to gross margin, shrink was a big hit earlier this year. Should we think of that shrink investment as the first part of a price investment, or what exactly was that? And do we think of that as sort of the first stage here? And then second, either for Doug or Charles, if we think about the whole company and the guidance you provided, where do Sam's International fit in this? Should we expect their EBIT margins to be down as well for next year because of some price investment or other investments in e-commerce? Thanks.
Do you want to go first?
Doesn't matter.
Shrinkage. As I said, we are really after this, and I think if you went out and you spoke to any of our store managers or anyone else in our business, I'll tell you that it's getting plenty of focus. We've got Shrink School back in place, so something that used to be part of our business is now back in place. So if you shrink heavily, then you're off to Shrink School to learn what you've got to do to get on top of it. I'm comfortable with what we've built into our plans going forward. Having done this for 40 years, this is not a 5-minute fix to fix unknown shrinkage. There are many parts that are at play. It's built into our guidance and our plans, as are many other levers within the business. But I'm comfortable that we're heading in the right direction, we're focused on the right things, and what we've built into the plans, I can sit here, as I said to you last Friday at the officers meeting, we're on the right track. It does help us. As I said, it turns from what I believe is a headwind and it will become a bit of a tailwind. But we're realistic about what we can achieve and how quickly we can achieve it.
The Sam's plan looks a lot like the Walmart U.S. plan because it's got the same two pressures. We invested in wages in Sam's Club U.S. just as we did Walmart U.S., and we've got the e-commerce investment. International looks a bit different because the value of the portfolio kicks in and the way Dave is thinking about it. So we've got puts and takes from market to market, and he's balancing some of his investments within that portfolio. And it's really helpful, Charles, right now to have momentum in Canada and Mexico, which are two of our more profitable businesses, both running strong comps and delivering results.
Carrie?
Hi, it's Dan Binder at Jefferies. I was intrigued by one of the slides you showed earlier that showed that Walmart's appeal to a blend of incomes matched that of the broader U.S. shopper. And I guess my question in that is, when you consider your online growth in dollars, relatively large in dollars but relatively small compared to your largest competitor online, do you think that there is something that you need to do more from an image perspective for the U.S. consumer, in that I think a lot of people think about Walmart as, you know, a place to go if you're on a budget. Amazon seems like it's for everybody. And so I'm just wondering if you think there's something you need to do there. And then when you think about the online investments that you've made, it's surprising that the dollar growth isn't more. And so you've told us a lot about what your customers are expecting in the store. What is it you think you need to do more of online to accelerate that growth?
Let me take that. So first of all, let's talk about customer demographics, and then we'll talk about revenue growth, and we'll focus the conversation on the U.S. So as Doug highlighted with that slide, the Walmart customer is a value-conscious customer. That value-conscious customer spans across different demographics, obviously. With the introduction of technology, technology doesn't discriminate. Technology makes available to those in all facets of the economic spectrum, Walmart. There, to our eye, aren't many brands that have brand permission to sell everything to everyone. So that's a big deal. The ability to sell groceries and general merchandise together is unique, really, to Walmart. So as we think about how to grow the online business and grow the customer, we think about how do we attract new customers to Walmart, which I think is the essence of your second question. And that's by introducing a level of service to our offering that is different than a mass market discount retailer would historically have provided. That's why you see the progress that we're making with grocery. If you look at the categories that have moved online, grocery is the last category to move online, and the reason is it's the hardest. So we can do that better than anyone else. That provides us a foundation for a relationship which allows us to bring those new customers into Walmart and then deepen the relationship that we already have with them. The second half of your question there, though, is around the assortment expansion, which is when we do the process of filling a supercenter to its catchment area and to its trading area. Obviously, the assortment that's in that supercenter is going to match those folks. That may or may not hit the entire spectrum. With the addition of online, we now have the ability to expand that assortment. So the 120,000 items online is about 10 million by the end of, or in the stores, about 10 million online today, and that continues to grow. Taken together, then, we have the assortment, we have the customer experience, and we have the brand relationship with the customer that allows us to drive that deeper relationship with the customers we already have, and to attract and build that deeper relationship with customers that maybe we don't have as much of right now. And then, as it relates to growth, it's worth realizing that we're a big business. Only in Walmart are we not only in Walmart would we say our e-commerce business is not a big business. So to double we were at, about $6 billion of sales, I think, in calendar 2011, fiscal 2012. So in 3 years, we've doubled that business. Doubling at that kind of scale is really attractive growth. We've taken we've taken share in every market in which we compete, and we expect to continue to do that. But it's really, as I said at the end of my remarks, about how do we grow the whole company, because it's, with Walmart, it's about this branded relationship with customers. How can customers across the economic spectrum who want to buy everything from general merchandise to groceries, how do we build a relationship with them based on the things they already know about us: price, assortment, access, and experience? They know they can trust us for low prices. They know we sell what they want to buy. We've created an efficient and fun shopping experience for them, and we have access that no one else can provide. So that, taken together, says we believe that we have the customer proposition that appeals to a broad swath of the population here in the U.S.
Yeah, I think that's well said. The other thing, Dan, is that the fulfillment centers weren't in place, so our split ships and our costs related to shipping were high. So if we had scaled it a lot faster, it would have been tougher on the P&L, and we're always balancing those things. But the infrastructure that Neil talked about today is much more developed than it was looking backwards.
Michael.
Peter Benedict, the Robert Baird. Doug, you had mentioned in your remarks earlier being open to portfolio rationalization or taking a look at that. So that's happened to some degree at Walmart over the last several years, but your comments seem to me at least to have a little bit more bite to them. So just talk to us about how broadly you're thinking about that, and really how important it is to you as part of the strategic plan over the next 3 years or so. Thanks.
Yeah. Charles, you can help me. I'll take a shot at it, and then you can fill in the blanks. Being the biggest and being the best are not the same thing, and we've got to be the best. And so these priorities that we're trying to articulate to you that we've set are just that. We have to win in some of these areas for the company to be successful over a long period of time. And it's meaningful to me personally that the company crossed the 50-year mark a couple of years ago, and mentally, I know 50 years sounds like forever, but I'd like to know that this company's going to be here in 50 years and be relevant. Now, to manage that, we got to manage the next 5 well and do what's necessary as it relates to being great at technology. I mean, we're adding, Neil, data scientists and mathematicians, and it's a very different Walmart than the one that I grew up in, and it's exciting. And as we think about those things in the most important markets, what we're saying to you and everyone else is we're going to make sure we win there. And if it becomes clear to us that other things, while they may be very important in some ways, keep us from achieving that, then we have to do something about that. So our message is we understand that there are priorities. We're committed to those priorities. And as things come up, and as in some cases as we actively pursue something, because as Charles said, we are looking at the math and the portfolio all the time. We understand what our investments are. We may make some decisions to do some things differently to deliver against that top and short list. Now, having said that, to be repetitive, we won't be too fast about that. We'll be intelligent about it. We'll protect shareholder value. I'm not one that believes in just writing something off because it may be perceived well by some. I'm trying to manage this situation like it's your money and my money, because it is my money and I know it's your money. So we've got to be thoughtful about what we do, and not everything will happen overnight. But we're clear that we have to win in some certain areas, and that's very much on my mind.
I think you said it well. I mean, remember what Doug said. We know we have to win in North America, specifically the U.S., e-commerce, and then integration of physical and digital. And we need to make some long-term bets in China. We think that's really important. Doesn't mean the other areas, you know, we can't focus on, but at the same time, we don't want to take focus off of what I just said. That's going to be really important.
Carrie.
Meredith Adler from Barclays. I'd like to ask some more detailed questions about your labor investments and maybe just understand a little bit better how it works. So starting with the labor budgets for the store managers, when you are increasing hours, do their labor budgets go up? And are their incentive comps adjusted to reflect the fact that they're going to spend more on labor?
Yes, happy to answer that. So there's a couple of things that have gone, or several things that have gone on. Obviously, we've moved the facility start rate. And, you know, once again, to be clear, that doesn't mean every single store got a facility start rate, because there's a reasonable percentage of our stores, whether through legislative reasons or the state of the market, because they might be in a state where there's high resources, we already are paying well above $9 an hour. But it does include a move for facility start rate for, you know, 2/3, 3/4 of the stores. We've also changed the structure in store. And a role that we previously had called a ZMS, which covered a wide portion of the store, has effectively gone away. And those people, in most cases, are either now department managers or assistant managers. So there's been a change in structure, and as well as that, we've added 8,000 more department managers in. We've also had a look at our staffing on our front end, and we're now lining up when we need registers open to when customers are in store. And literally, as I speak, we're rolling out a system which initially is going into neighbourhood markets. We'll have that completed this year, and then next year it will go through all supercentres, that will deal in a much more specific and accurate way with correct scheduling in stores. So we've got two things happening here, or three things. We're changing the structure of the store, we've moved facility start rates up, and we're adding in hours. And we've got to do this really sensibly and carefully, because if you go too far, costs go up too much. If you don't go far enough, you don't change the shopping experience and get the customer aligned with the changes that we're bringing to Walmart. So that's what we're balancing. And as everyone's mentioned, we've got another heavy year of investment next year to get that right. But when we get it right, we see improved comp sales.
And maybe I missed your answer. A store manager compensation is perfectly aligned with...
That's correct. So if we change that, then they are bonus to the new plan, which would take into account the increased hours.
I have another question just about, you've obviously raised wages for your entry-level workers. Have there been any changes in the wages you're going to be paying the people who are not at the entry level, who have been with you for a while?
So the answer is some small changes. So as we introduced the change in April of this year, people who, we call them capped, so they hadn't had an increase for several years because they're at the top of their rate. Many of these are long-term associates. We gave them an increase. We're now dealing with the other issue that you've raised. We call it compression internally. And we're just working out how we manage that on top of moving to $10, on top of more department managers. So there's a population, and as you can imagine in Walmart, nothing is ever a small number, but there's a population of associates who've been with us for maybe 10, 15 years, who now have quite a small gap between what they're earning and what someone who's new into the business. So we're working out how to deal with that, and that is built into our plan and our guidance.
Ideally, this starts to look like a ladder, and in some cases it has and it does. We want people to join the company and have an opportunity to move up. We want to create a meritocracy. So one of the other things that we've done is the department managers, which is a highly valued and very important role in the company, have received an increase. And some of them that have the more complicated departments will make $15 an hour next year starting. And so some of the longer tenured associates, we're trying to guide them towards running one of the departments because that gives them an opportunity to move up. And then ultimately, we would like a lot of people to become assistant managers and eventually store managers. We really want to develop a pipeline of talent, and to some extent have, but with our growth, we've stretched that and needed to come back and put some of the rungs in the ladder in the right place.
Michael.
Great. Thanks, guys. Joe Feldman, Telsey Advisory Group. Just wanted to ask about the store managers and the turnover there, because you talked about the clean, fast, friendly stores, and you're at 2/3 today of where you'd like to be, and obviously there's a long way to go. And you've made a few comments. You can very clearly see when there's a good store and a bad store, and you can almost predict what the sales will be. So what are you doing, I guess, about the weaker stores and the turnover of those managers, and maybe finding better talent for that store? Thanks.
Sure. So lots of work has been underway, and you'll be across some of the changes. So Judith McKenna really runs that part of the business. She's doing a great job. So she realigned her teams, and Mike Moore, some of you will know, who's been with us for many years, probably the best big store guy that I've ever met. Walking a store with him is exceptional. He now runs Supercenters. Julie Murphy runs all the neighbourhood markets. They've had a look at their teams. In the case of Mike, he's got 6 divisionals hand-picked. So he's realigned that team. And then we've got about 50 regionals who report to the divisionals. Once again, hand-picked. And there's been about a 30% change, once again, to be candid with you, in regionals. As the regionals change, they then start to change the market managers. The market managers are the group of our associates that might run 8 to 10 supercenters, or in the case of neighbourhood markets, 13 to 15 neighbourhood markets. It's because the neighbourhood market's smaller, you can look after more. So what's happening is that as we're making these changes, it's cascading down, and we're seeing turnover in some of the areas, which, once again, to be candid, we're forcing in some cases. In other cases, people are getting promoted, and we've done a series of those, and there's people like Terry Nanny, who comes to mind, who's just now running one of our regions and just doing a marvellous job, and a whole bunch of others. We've reinstigated store manager training school. So even as recently as last week, in the office on Friday, I think I saw 3 or 4 groups of new store managers coming through. You go back several months, we had a few hundred stores without store managers. I can sit here and tell you today that is not the case. We've still got vacancies, and my objective is to literally have none. But it's starting to get better, but it doesn't happen overnight. And to become a great store manager takes several years. So we're on the path. We know what we've got to do to fix it. We're doing it. And give us another couple of years, and this strength of great people running stores, I think, will be back.
Okay, Greg, you set the bar this year for clean, fast, friendly, and 2/3 have made it so far. Are you going to move that bar next year?
Yes, so it's already moved. To be, once again, to be candid, the level that we were at sort of put us right at the bottom. And we only had 17% of stores that actually got the pass mark at the beginning of the year. Because we obviously track how we rate relative to our competitors. So by moving the bar to where we did, where we're now at 67%, is really only getting us to, at best, mediocrity. So that bar's now been moved up so that a whole bunch of stores that were green are now going to find themselves red, but they've all been told that, they've bought into that, and so they've now got to strive. If they can get to green, then it sort of gets us to the bottom of the first quartile, the leading group. I want to do better than that again, but let's step our way through this and give people a chance, bonus them around that so they know how serious it is, and we'll get there.
I just think it's important that people understand if the percentage starts to come down, it's partially because we moved the bar.
Two questions. Charles, for you on capital spending, specifically, how have you come up with the $11 billion number? Is it a top-down number, a bottoms-up number? And why was capital spending in the domestic division this year up more than you planned at the beginning of the year? And then for Neil, subscriptions are becoming a much bigger part of e-commerce going forward, both in services and goods. Where are you in that business? You have Voodoo. You don't seem to be able to marry that with the retail business. Can you talk about some of your subscription strategies?
Yeah, I'll take the first couple on the $11 billion. That really is a bottoms up with a top down then review, and looking out 3 years, and then understanding from history what is it that we think we can really spend or not spend or should spend. And that just comes as Doug and the executive committee get together and talk about what would be the appropriate thing. And then I'm looking at it also at a financial lens. Does this make sense? What happens financially to the company? And we felt like that was the optimum. But like I said, that number can be subject to change if we feel like, for instance, if Greg and his team felt like the neighborhood markets, they had the management trained, and they had the fresh areas where they wanted them, and we had the sites that we felt like were great for customers, you could see that number go up. But right now, that's our best understanding of where we would be.
I guess my question is, why isn't it 10 million, or why isn't it 10 billion, or used to be 13 billion? I mean, how?
Well, we look at what do we think we need to do, Michael, to maintain our stores, and our depreciation's $9 billion or whatever. I would expect that you would spend that at least to maintain what you have over the long term. And then you look at what are the opportunities, and versus, if you remember what I said, we want our CapEx to track our priorities. So we look at those priorities and what investment it will take to make sure that we go through with those priorities like we would want to. That's how we came up with the 11 versus a 12 or a 10.
Michael, on the subscription relationship with the customer, we think about it as this digital relationship that we've been describing today. That's the ante. We would like every one of our customers to be using their mobile app and having an account with Walmart.com. That provides the foundation of our ability to have a one-to-one relationship with those customers. And then we can sell subscriptions, we believe, on top of that. And so we've tested, obviously we're testing Shipping Pass, which is an unlimited shipping offer. Voodoo is a transactional media business as opposed to a subscription media business. So they've taken share in what they do, which is the EST business. But as you think about that digital relationship, it's a big move for us to have that digital relationship. There was a long conversation about everyday low price and the consistency of that relationship. We're past that now to say, hey, a customer expects a personalized shopping experience, and we can deliver that through the device that they have in their pocket. That provides us the foundation. On top of which, then, we start to sell these subscription services, and whether that's for razor blades or free shipping or media over time, we believe that we can merchandise those once we have that relationship. And we feel good about the progress that we're making. Those will be a bigger part of the future than they are today.
Okay, we have time for one more question.
Thank you. Thanks for lunch today, by the way. I had actually 3 questions, one for Doug, one for Greg, and one for Neil. So, Doug, in your earlier presentation, you said you wanted to go where there was growth. In that, it suggested to me that you're looking to go after a little bit of a different customer demographic in America than you have in the past, maybe a bit more influent, because that's where we're getting the job growth and the income growth. So that's the first question I had. Is that an accurate perception?
Yeah, I think that'll be the outcome. That doesn't mean that we're going to take our eye off the ball as it relates to opening price points and customers at all income levels. But the nature of e-commerce, the nature of the neighborhood market, and other things that we're doing do create an opportunity for us to be even more relevant to customers that are at the higher end of the scale. Running cleaner stores also does the same thing. So I think if you look at where we match up against the bell curve in the future, it'll be even closer of a perfect match to what exists in the United States. But I wouldn't want you to think we're going to walk away from customers that are most focused on value.
Got it. And then Greg, in terms of your outlook, your North America segment margin, I think, was 7.5 last year. We kind of work out where you're going to go over the years, the next 3 years. But is the majority of the decline in your gross margin or in your operating margin rate or your segment margin rate to come from gross margin, or is it to come from SG&A?
I think, as we've already identified, a lot of the costs we incur next year is absorbing the extra $1.5 billion that we're investing in store wages.
Okay, and in terms of the billions of dollars in savings, in terms of fresh, a lot of the criticism or concern has been in the quality of the value that you offer. So when you say, billions of numbers, is that thinking about it in terms of both enhancing the quality and also lower everyday prices?
I've lost you a
the
bit
quality
on
of
that one.
fresh.
Quality of fresh.
Yeah. Greg can chime in here, but there are categories where the customer is really focused on price, and you sell Tide against Tide, and price is what they're using to make that decision. There are other places where quality is a much more important part of that value equation. Apparel is right. If you don't have the right color, forget about it. In produce, quality is the thing. And I think when we created Supercenters, we took a lot of our DNA on price and we translated it into what we did on the food side of the box with our fixtures, with our assortment. And especially in produce, but also in meat.
Yeah, they work it out, don't they? Customers will have a look at your avocado and you might be selling it for 50 cents. And if the guy down the road's selling it for 80 cents, but it's a larger avocado and it's demonstrably different, the customer makes a value decision. So, it's one of the challenges with fresh, isn't it, is that you need people working in your departments, working in your stores, who are able to make some of those value judgments. Not all avocados are the same. Not all pieces of muscle meat are the same. So you need that ability right through your organisation to make those calls. At the end of the day, where we want Walmart U.S. positioned is to be giving the best value. In Tide, that's got to be, you've got to have the right price. In the case of fresh, it's a value decision.
Okay, I'd like to thank all of you for joining us here today. If you could stay in your seats for just a minute, we are going to conclude our webcast at this time.